Welcome to the Lend Academy podcast, session number 23. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to welcome Dave Girouard. He is the CEO and founder of Upstart. Upstart are the new kid on the block. They've been around about 18 months. They've only really been doing the 3-year unsecured consumer loans for a few months now. And they are really targeting a borrower that is slightly different, that's difficult to underwrite. They feel like they've cracked the way to do that. And we're going to learn more about how they've done that on the show today. Now, full disclosure before we get going, I am an investor personally in Upstart's loans as well as through Lend Academy Investments. So I have been using their platform now for several months. And obviously so far it's too early to provide much of a judgment, but wanted to let you know that I am investing with Upstart today. So on that note, I hope you enjoy the show. Thanks. Welcome to the podcast, Dave.
Great to be here.
Okay, so let's just start off with giving the listeners a bit of a background about yourself and how you came to start Upstart.
Sure. I've been in the technology business for 20 plus years in the Bay Area, small businesses and large businesses. I was at Apple in product management for a few years. More recently, I was at Google for 8 years as president of Google Enterprise. And it was really toward the end of that time that the notion of Upstart came to me. And really it was an observation that young people aren't served particularly well by the financial institutions out there in the area of credit, and that the way traditional underwriting works, it's really ill-suited for people who are younger or earlier in their careers. And the notion generally was, at Google we were hiring hundreds, if not thousands of people in this age group, and we were making, hiring decisions very much driven by data. Larry and Sergey always like to make data-driven decisions. So generally the Google hiring model was thought of as could it be a proxy to an underwriting model, to making a credit decision by understanding things that we looked at Google, like where they went to school, what they studied, how they performed academically, because these are signals as to somebody's employability and earning potential, and through that to their credit worthiness.
So you sort of created a Google hiring model, so to speak, when you were there, did you?
Yeah, I was pretty involved in that, and it was something where over time we were trying to, better understand and predict who would be successful as an employee at Google. And again, engineers run the companies, and their way of thinking is to use data to drive that more so than the subjective opinion of mere human beings. So we definitely had a bent towards using data to make hiring decisions. We didn't eliminate interviews, but we probably came closer to that than any other company.
Interesting. So then I know that you've got some co-founders there. And did your whole team of co-founders, did they all come from Google, or what? How did the team come together?
Well, the team is today about half ex-Google, but one of my co-founders, Paul Gu, who's really the data scientist part of the team, was not from Google. He's actually a Thiel Fellow. He won a Peter Thiel Fellowship for the kind of 20 under 20, where he got a scholarship to actually leave Yale, where he was studying computer science and economics. And so I met Paul just at the time I was exiting Google to found Upstart, and he decided to join me. We were both just very interested in the idea of using alternative data sources in order to model, both income potential and creditworthiness of younger people. My other co-founder, Anna, was at Google with me for years. She ran Gmail consumer operations and a bunch of enterprise operations, and she's kind of the operations guru at Upstart.
Okay. So then you decided you wanted to serve these young people who really are underserved by, traditional banks and also by even the other peer-to-peer lenders. So, how did you came up with this idea of income sharing agreements, which you launched with. Why did you decide that was really the particular concept to launch with?
Well, I think we sort of wrapped up a few things together that maybe we shouldn't have in terms of understanding, the issue of lack of access to capital, the concept that there's other types of data you could use to underwrite, And then in the end, we designed a concept that was really a new type of financial asset, an income share agreement, which in the end, we had some progress with, and it has a lot of interesting attributes in terms of only having to pay when you have the money to pay, which is really the design of an income share agreement. But in the end, a simpler and more mainstream product alone has shown itself to be much more readily accepted and able to grow very quickly in the market.
Okay, well, before we get to that, can you explain exactly how the income sharing agreements work?
Yeah, sure. The simple idea is, we modeled somebody's future earning potential and then set a price that suggested that, for example, if you want to raise $20,000, you might share 2.5% of your income over the course of the next 10 years. So it was money today, much like a loan, but the repayment was not based on a fixed interest rate, but based on your actual earnings. And that's really where the underwriting and the sort of modeling started for Upstart.
Okay. So then when did you launch exactly?
We launched that product at the beginning of 2013.
Okay. So you sounds like you had well over a year into it, and then earlier this year you made the big decision. Obviously, because I've looked at some of your early materials. I've seen interviews, and you really were talking up this new concept in financing, which is the income sharing agreement. So it must have been a very big decision to basically abandon the concept that really your initial investors obviously believed in and you believed in. So what was the thought process around that pivot?
Sure. Well, I don't think we necessarily think of it as much as abandoning, as much as just modifying the end of the funnel, which is the product that we actually delivered the value through. Mm-hmm. We basically saw that, it would be much easier to access capital because the 3-year unsecured loan product we have today is a very well understood product. And also from the borrower side, it's just a much simpler value proposition. Everybody understands a loan at a lower interest rate, a loan that's easier to get, and so the borrower experience and the actual way to compare loans is obviously almost universally understood. Whereas the notion of an income share agreement, it's pretty hard for a borrower to grasp, is this a good deal or not? How do I compare it?
Right.
And so it's the difference between evangelizing a totally new concept where you need to educate the market and actually just walking into an enormously large market opportunity with a unique value proposition.
Right. Yeah, that's fair enough. So, can you just talk through, who are your typical borrowers today, and what, are you really just focusing on that young demographic, the people who are just out of school, or are you broadening your horizons?
Well, our product is designed, obviously some of the underwriting that we do has a lot of value for people who have, let's say, less than 10 years of credit history. Generally speaking, our borrowers are probably from 20 or 21 all the way up to 35 or so. So it's actually quite a spread, and a lot of those borrowers would fall into what lenders would call a thin file borrower to different degrees. Others aren't really thin file borrowers at all, but they still like our product. So it's generally all in. It's a younger borrower than you typically see on the other platforms, though there's certainly some crossover.
Right. Okay. And so what are the terms you offer? Are you said 3-year loans? Is that the only product, and what are the interest rates?
Yeah, it's a simple 3-year unsecured loan. We don't have a 5-year product like the other platforms do. We may someday, but we don't today. And it's a $3,000 to $25,000 loan. The interest rates can be as low as 6 or 6.5%, and they go up to about 20%. So they don't go as high as they do on the other platforms, but they are structured in a similar fashion. It's a unique rate for every applicant.
And these, where do you fit on the FICO spectrum? I know some of these people, their FICO score will be pretty meaningless because they've got such a thin file. But is FICO one of the data points you look at? What type of borrowers? That's what I'm trying to get at. What type of borrowers
Sure.
are these? Are these prime? What kind?
Well, we generally refer to them as future prime,
Okay.
meaning these are high-quality borrowers who tend to have thinner than usual, than typical credit files. In terms of FICO, most you don't have to have a FICO score, though the vast majority do, and it tends to be in or about 700 average. So these are actually high caliber borrowers in terms of FICO. They tend to have lower debt to income than you see on other platforms. grade for grade, what you'll see is our borrowers have lower debt to income than what you'll see for the same equivalent borrowers on Lending Club or Prosper. And that's generally because they haven't had the time to build up as much debt, and they also have a shorter credit history, so we require a lower debt to income. So they are sort of different notionally. These are people with more free cash flow, less credit history than you'll find on the other platforms.
Okay. So let's just dig into the underwriting model a little bit, because it's something that I know has garnered a lot of attention, because you really are looking outside the box with some of the data that you use. And you talked about what's gone to school, what kind of grades you use. I mean, I'm just trying to picture for the listeners. A borrower comes along to Upstart. There might be a Stanford grad who is who's really 2 years out in the workforce and has a very, very limited credit history. I mean, how do you decide based on this limited credit file? I mean, what weight do you give to the fact that this is a Stanford grad? They might have done a computer science degree or something like that. I mean, where do you draw the line as far as financial data versus this kind of, one would say, alternative data?
Sure. So I'll say first that we decidedly have not thrown out 30 or 40 years of underwriting history. So we start with the same notion any lender does, which is trying to understand the borrower's financial capacity to repay a loan, and also their kind of personal propensity to pay. You're kind of holding financials constant. Do they have the characteristics and the likelihood of paying back a loan? So we're very similar in that regard. We actually look at every credit variable others do in terms of understanding not just their FICO, but how many accounts they have open, their sort of debt and other sort of existing obligations, how many inquiries they've had in recent times, et cetera. So we look at all those things, but what we do that's different is we extend those by adding the educational variables, such as where they went to school, what they studied, how they performed academically. And the rationale is this: if you're looking at somebody at a moment in time and they're earning, well, let's just say $50,000, and it looks like that's sufficient to pay a loan based on what you know about their other obligations, that's fine. But if they're someone who's only been at the job for a year or two, you might not feel too confident that they'll be at that same job for the next 3 years. So for us, it's important to understand their underlying employability. Young people move around a lot, they change jobs. So we use the educational variables not to replace all the credit and income variables, but to actually buffer them and develop a better understanding of how this person will survive in a downturn, what their employment prospects are, irrespective of this moment in time. So we're really, not as different as you'd think from others, other than we are adding a whole layer of data that others don't see. Okay.
When we chatted a few months back, you made the comment that you said that 90% of your borrowers are from really top-notch schools. I don't know whether I think the term you used was schools names that we would recognize. Is that still the case? Is that something you hold dear as far as or is that just the kind of people that you're attracting?
No, it's probably not accurate. I'm not sure I said exactly that. I mean, almost 100% of our borrowers are graduates of four-year college.
Okay.
So that's actually what's very unique about us is we're almost 100% four-year college grads, and that is one thing you can easily understand about us. But beyond that, we're not just looking for Ivy League or Stanford or top schools. We're actually looking to get a better understanding of someone's employment prospects. And we do that, it could be that you went to, maybe just an okay school, but you had you studied a major that's very employable. For example, nurses are very highly employed. They're very rarely unemployed for long periods of time. So nurses, generally speaking, can get great loans on Upstart. And even if you weren't in the most lucrative of majors and not at a great school, if you had really high grades, that sort of says a lot about you, and employers tend to notice, and we notice. So what we do is really balance things like the quality of the school you went to, the area of study, and then how you performed, because those are all sort of pieces of the puzzle in understanding, the likelihood of you paying back the loan.
Okay, so that's good. So you're not just talking about the high tech industry. I mean, nurses is a perfect example. That these are people you might have a nursing degree from somewhere that's a school that no one's ever heard of. So the fact that it's a nursing degree, the fact that you've somehow measured all the different types of careers that people have and the employability. That's I guess you somehow provide a score to each career choice. Is that sort of what goes into the model?
Yeah, a little bit. It's a regression model. So all these variables conceptually operate independently. The quality of the school, the economic outcome of any particular major, and then how you sort of ranked against your peers. Those are all sort of signals in what amounts to an algorithm that is trying to understand your employability. And that, of course, is additive to the fact that you are today employed and making a certain salary, and that's kind of a very strong data point, of course,
Sure.
relative to the others. So we do balance them, and generally speaking, the educational variables are more predictive and more important the earlier you are in your career. The further you get along, when you begin to have 4, 5, 6, 8 years of work experience as well as credit experience, the educational variables are less predictive and we weigh them less.
Right. Okay. So then obviously there's a large population of borrowers out there. People are looking to borrow money for all sorts of things. We all know about the Lending Clubs and Prosper story about the debt consolidation. Is that similar to what you're seeing, or what are the uses of the funds for your borrowers?
Sure. There's some things that are similar to the others, and then there's some differences. So for sure, debt consolidation, primarily credit card consolidation, is our number one use case, not unlike the others. And I guess it's no surprise. I mean, there's just a lot of people paying high-interest credit card debt. And in our case, it's a lot of people who built up that debt during school or in the early parts of their careers, and they're now kind of getting over it and wanting to move on. We have people doing other things like relocation, starting new jobs, large purchases, things you do see in other numbers in the other platforms. We also have a significant number of people doing things like taking a coding course. They want to be a software engineer.
Right.
Or in some cases, refinancing high-interest private student loans. So we do have student loan use cases that aren't supported on the other platforms, and it's kind of appropriate for our demographic.
Right. Okay. So then how are you marketing to, obviously you not going to give away any secrets, but how are you attracting these borrowers?
Sure. Well, we use a lot of different ways, and some of them bring us free borrowers and others are paid sources. And, to be a solid, responsible company, of course, you have to develop a diverse source of borrowers. Mm-hmm. And we're doing that. Places that you'd imagine like large online advertising networks, to social media, to other types of platforms that direct potential borrowers to you. So we're kind of opening that up very quickly. And, as of now, we have 4 or 5 different sources that are all growing and sending us borrowers with, somewhat different economics to them. But right now, our loans are profitable already by a significant margin, and we're growing very quickly. So we feel pretty good about where we are. But we definitely know that there's a lot of folks out there with compelling loan offers, and there's more every day. So, being very, very good at finding new borrowers, having a compelling proposition, doing that economically, doing it at scale is fundamental to our success.
Mm-hmm. Sure. And on that note, as far as the borrowers go, do you find that a good chunk of them are ones that couldn't get a loan elsewhere, or are you finding that people are saying, right, I'm going to try and apply to Upstart, I'll apply to Lending Club, I'll apply to Prosper? What are you seeing as far as the borrower's behavior?
Sure. Well, most borrowers are going to look at multiple websites as quickly as they can, particularly ones that are able to give, offers of credit very quickly. Mm-hmm. So we definitely believe that people do look around, and they should look around. And relative to Lending Club and Prosper, for sure, a large part of our borrowers either couldn't get loans on those platforms because they don't have enough credit or work history, or they could get them, but they wouldn't be at very compelling rates, because that's such an important part of how Lending Club and Prosper do underwriting. There's certainly some of our borrowers that can get good loans on those platforms, either at a similar rate or maybe even at a better rate. It's not by any means a kind of perfectly liquid market where everybody gets, the lowest rate. It's also not the only way people, judge the quality of a loan. So our view of the world is that people are going to, move quickly toward the best loan they can find, and you need to have a compelling value proposition, both in terms of the rates that you offer for a particular population, as well as the borrower experience, and that's something we're very focused on.
Right. Okay. Okay. So let's switch gears a little bit and go over to the investor side of the equation. Just tell me why I'm an investor. I know you're open only to accredited investors, but say I'm an accredited investor who has an account with Lending Club, maybe Prosper as well, or either or. Why should I consider Upstart as an addition?
Well, I think we've accomplished something that the industry's been trying to figure out a long time, which is there's almost a notion that prime borrowers are tapped out, that they've all been sort of sourced and we're done. Sort of the way the U.S. looked at the oil industry, right? Mm-hmm. Oil in the U.S. is done. You got to go get it overseas. And what we're saying no is, if you actually use different data that others aren't using, there's an enormous pool, millions and millions of borrowers who are what we call future prime. They're very, very high-quality borrowers. It's just that people don't know it yet. And that's kind of the heart of our thesis is, people in their 20s statistically default on loans at a lower rate than people in their 30s, 40s, or 50s.
Interesting.
That was a fact surfaced by a Fed study. But the issue is lenders can't distinguish between the high-quality borrowers and those that are less so on the normal way they've done underwriting in the past. So what we have really is all of a sudden a large influx of prime borrowers that others aren't able to find. And that presents a unique investment opportunity. And I would just say one of the important things, because we are a newer platform, we don't have 7 or 8 years of history, is our target return to investors is probably at least a couple hundred basis points higher than you see on the other platforms. And it's really because we have unique underwriting and we're able to actually identify and make a great proposition to the borrowers.
So what you're really saying is that investors can diversify into really a new population of borrowers at the same time be rewarded with potentially higher returns.
Yeah, when you're new in the market, you're going to have a higher return. And, what we call future prime borrowers are people that should be part of any loan portfolio because they represent people with a lot of forward earning potential, people that have shown themselves by performing in school. And that's our proposition in essence to investors.
Okay. And let's just go through the investment process a little bit. I mean, as I said at the top of the show, I am an investor both personally and through my company in the loans of your company, of Upstart. And, I believe you're changing things here in the near future. But so explain how investors can access the loans in Upstart and what changes you are making.
Sure. So one of the changes we're in the midst of making right now is, we were really the first platform to offer auto investing to everybody, meaning that, every retail investor can invest at the same time with the same speed and the same automation that an institutional investor could invest at. Well, we're actually going a step further. We're actually going to have all investing on Upstart be automated. And what that really means is if you want to invest in Upstart, you can sign up on the website. You can choose any filters or approaches you want, by grade or by FICO or some other sort of filter that you choose to set up. And then you, of course, can set a budget, how much per loan and how much per week or month, and we'll automatically invest. But what you won't be doing on Upstart is browsing through pages of loans and picking and choosing loan by loan. There's several reasons we're doing that I'm happy to go into, but that's going to be the investment experience on Upstart is, the notion of being able to filter and choose the types of loans you want, but it's all in a very automated process where everybody gets to see the same loans at the same time.
Okay, so then how are you going to, say a new investor signs up and you can't browse through the loans, how are you going to present them with the typical kinds of borrowers that they're used to seeing on the other platforms? I mean, how are they going to know?
Sure, you'll actually be able to browse through and see hundreds and hundreds of loans. So you can get a sense of what a B grade loan looks like or an A, or et cetera. So you'll be able to see tons and tons of loans, but you can really only invest according to filters or rules as opposed to picking them individually. In essence, we don't really believe there's a lot of value created when somebody is trying to discern between, two different B grade loans that look very, very similar. And we feel that it makes more sense and it's more, time efficient for investors to be able to decide the type of loans they want up front and to invest automatically.
Yeah, I mean, I totally agree. I mean, that's what I've been sharing how I invest now for a long time, and I'm a fully automated investor. I don't browse loans. I think it's you introduce human prejudices, and I think it's much more efficient to decide on what kind of loans you want and then just let it roll. I mean, I think that's a smart move.
Well, the big reason, though, to be honest, the bigger reason is from the borrower perspective, which is, on the other platforms, if your loan happens to get funded as a whole loan, it funds very quickly, and that's a good day for you.
Yep.
But if it happened to move into the fractional pool, your loan might take up to 2 weeks to fund. And as a borrower, borrowers don't really care about the notion of a marketplace, right? They just want to...
Yeah, they just want their money. That's all they care about.
Their money, yeah. So what we're basically saying is, look, we want everybody to fund quickly. We want to be able to tell borrowers, you'll get your money, maybe even tomorrow. And to do that, it's just at odds with the notion of letting loans sit in a marketplace where people can browse and pick. So what you're seeing on our side is a focus on the borrower experience, meaning people will fund quickly, but at the same time doing it in a way that investors get to participate, actively and on equal terms.
Right. Okay. So speaking of whole loans, are all your loans fractional today? Are you going to have a whole loan program?
We do have a whole loan program. We announced just a couple of weeks ago that Victory Park Capital is investing $100 million in loans.
Right.
And they have been now buying for a few weeks now, and that's really the launch of our whole loan program.
Okay.
So we're having conversations with others, but yeah, we expect to have a mix of fractional and whole loans. Okay,
so let's just talk about that Victory Park deal. I mean, it's $100 million is a massive investment for someone, for a platform that's still fairly young. How were you able to close a deal like that, given your limited history?
Well, I think first of all, it's sort of what we discussed earlier. Our underwriting is not an enormous leap of faith because we actually use all the same criteria that every lender uses. We're really just supplementing the view of a borrower with the educational data. And it's also very intuitive. People that go to better schools tend to default less. People that work hard and get a high GPA tend to be the same people that care about FICO scores and are very diligent about repaying their debts. So a lot of what we're doing is very intuitive, and we actually have an enormous amount of data to support it. And second to that, when you just look at the loan book, when you look at the quality of borrowers to date, you can look at the FICO score, the debt to income, any other attribute you want, and what you'll know very quickly is it's a high quality book. So even though our history is somewhat short, what we've been able to do and what we can already show people today, I think, is good enough.
Okay. So I want to just talk a bit about your target market and sort of the future of what you're planning on offering. I mean, I had Mike Cagney, CEO of SoFi, on the last episode, and he's going after he's totally focused on the student loans to basically get the customer in and to start a relationship. I mean, you're not just totally focused on student loans, but you are focused on a young demographic that will presumably have financing needs throughout their life. Are you thinking down the road? I mean, is Upstart going to be a company that will provide multiple loan products over the long term?
I think we're definitely somebody who will seek to serve the demographic in many ways over time with other credit products. And who knows? A lot of the borrowers on our platform, probably more so than elsewhere, are people who will be high net earners, within a few years. They may have credit card debt or student debt now, but if you project them 5 years out, they're people that are creating a lot of wealth. And so that is a very, very valuable customer. Mm-hmm. And it's one any bank in the world would love to have. So naturally, we think that, people in this age group don't have any particular affinity for banks. Banks are kind of just this neutral thing out there that they don't think much about. So we think there's an opportunity to build a brand and a company that serves them more and more of their financial needs in a way that works for them, is not designed around a bank and a building, but designed around their life and the way they live. And, credit, a simple unsecured loan that radically reduces your cost of debt of your credit cards is a great place to start, but there's obviously a lot more we can do there.
Sure. And as you say, the people who are the 20-somethings of today are not going to have these long multi-decade long relationships that their parents or grandparents might have had with a bank. They're going to look for something that's a little bit more innovative. They're going to look for someone online. So I could totally I can totally see how a company like yours could, you could be the financial institution of choice as you go forward. So obviously you're going to go beyond 3-year unsecured consumer loans over the long term. That's fair to say.
I think it's fair to say, and banks really have amazing infrastructure in terms of everything behind them, the regulatory part, the way cash is moved and managed. I mean, the infrastructure of banks is awesome, but the UX is a disaster. Mm-hmm. And increasingly, I think what you're seeing is banks going from being retail consumer-oriented notions to wholesale-oriented notions where the UX is delivered by newer companies like us who are really thinking about the experience that the client really wants.
Mm. Okay, great. Well, on that note, I have to let you go, but I really appreciate you coming on the show, Dave, and best of luck to you.
Thank you, Peter.
Okay, bye.
Bye-bye.
Okay. Upstart are certainly one of the young companies to watch here in this industry, I think. They are targeting a slightly different demographic of borrower, as Dave eloquently pointed out in the interview. These are the future prime borrowers of tomorrow, and as such, we're trying to get at them before they are prime. So the theory is that these people will be really solid borrowers, solid payers of their loan. And as an investor, by including Upstart in your portfolio, you do get a broader diversification. Now, obviously, I'm not providing investment advice here, but I have personally invested in Upstart and have been happy with them so far. Anyway, on that note, I will sign off. Thank you very much for listening. I will catch you next time. Bye.